Imagine waking up, you grab your coffee, you open your crypto portfolio tracker. Right.
A standard morning routine.
Exactly. And right there on the screen, your balance says you are holding like $15 billion.
Oh, wow.
Yeah, you are suddenly one of the wealthiest people on the planet. But, and here's the catch, when you actually try to hit the sell button, just to withdraw $20 for lunch, the transaction fails.
It just flat out fails.
Right. The screen says billions, but the actual vault backing those numbers is completely, utterly empty.
It is the ultimate digital mirage. I mean, it's a phenomenon that isn't just a glitch either. It is mathematically baked into the system, and it's catching, frankly, an alarming number of investors completely off guard.
Which is exactly why we're here today. Welcome to the Deep Dive, everyone. We are thrilled you're joining us. Our mission for today's Deep Dive is to dissect exactly how that mirage is constructed.
Right. We really need to understand the mechanics of this.
Yeah, we're going to figure out why digital tokens that look like they're worth billions on your screen can just, collapse to absolute zero in a fraction of a second, entirely vaporizing investor capital.
And we are not just talking in theories today either. We are pulling directly from a really revealing stack of intel.
A huge stack.
Yeah, we've got real-time base network data, some promotional materials from BitChit Wallet, these chaotic social media streams off Binance Square, and a really comprehensive risk report on a highly specific token ecosystem.
Okay, let's unpack this.
Okay.
Because the central case study here is just wild. We are looking at an ecosystem operating under the ticker symbol USOH, which initially stood for United States Oil Holdings.
Right, United States Oil Holdings.
And if you read the original pitches from the developers in our sources, the concept actually sounds, brilliant.
On paper, yeah.
Yeah, exactly. They launched this on the high-speed Solana network, claiming they were going to tokenize physical U.S. oil reserves, refineries, infrastructure, all of it.
Real physical assets.
Right. The pitch was all about letting everyday investors get direct on-chain exposure to the energy market, auditing real-time reserve data, voting on governance. I mean, it sounded like a massive leap forward for the democratization of energy.
Which is exactly why the narrative gained so much traction so fast. In theory, tokenizing real-world assets, or RWAs as they're called, is an incredibly powerful concept.
It really is.
Our sources actually highlight macroeconomic projections suggesting that the global tokenized RWA market could hit $507.8 billion by 2030. So putting physical commodities on chain is a legitimate frontier.
Definitely.
But what's fascinating here is the stark contrast between that polished institutional projection and the extreme fragmented reality of how it's currently playing out.
Right, because networks like Solana and Base, they don't have a CEO or like a compliance department approving what gets launched.
No gatekeepers at all.
Yeah, they're entirely permissionless.
Exactly. Anyone with an internet connection can write a smart contract and mint a token. So instead of USOH becoming this unified, institutional-grade oil market, it almost immediately devolved into a decentralized speculative playground.
Just instant chaos.
Total chaos. The original contract was instantly drowned out by competing, bizarre copycat tokens, and they were all using the exact same USOH ticker just to confuse algorithms and traders.
Which is completely evident when you actually look at the on-chain data. I mean, the noble narrative of bridging physical oil to the blockchain just got hijacked in a matter of minutes.
Literally minutes.
Yeah. Instead of just United States Oil Holdings, developers started launching spin-offs specifically designed to capitalize on geopolitical anxiety.
This is where it gets really dark.
It does. The most glaring example in our stack of sources is a token literally called Unstable Strait of Hormuz. And again, they're using the exact same USOH ticker.
It's a brilliant, if totally cynical, co-opting of the original premise. Yeah. I mean, they stripped away all the utility and left only the pure speculation.
But wait, hold on. I get that crypto is speculative, but is there any actual utility here at all? I mean, why would anyone buy a token based on a volatile trade corridor instead of a token based on actual physical oil?
It's a great question.
Like, are these developers just scraping news headlines and launching tokens as a joke? Because buying a token based on an oil choke point seems less like investing and more like, I don't know, a bizarre digital casino.
It is exactly that. It's the tokenization of regional instability. If you look at the risk assessment report we have, the Strait of Hormuz is outlined as one of the most vulnerable maritime corridors in the world.
Right, a massive bottleneck.
Exactly. Historically, it is highly sensitive to disruptions. It's so crucial and so vulnerable that nations like Oman are actively pouring capital into alternative pipeline routes, like the China-funded Duke Port, just to bypass it entirely.
So it's a massive real-world geopolitical flashpoint.
It is, but for retail speculators who are just scanning decentralized exchanges, buying the unstable Strait of Hormuz token has absolutely nothing to do with hedging actual oil shipments.
Obviously not.
Right. It is an unhedged, purely narrative-driven bet on the idea of shipping disruptions. They aren't investing in oil. They are speculating on the meme of global instability.
That is just wild to wrap your head around. But, okay, if these tokens are nothing more than rapid-fire speculative bets on news memes, how on earth did the valuations get so massive? Because the numbers we are looking at in these sources are just staggering.
They are staggering on paper, but, and this is key, they are entirely manufactured.
Right, let's talk about the math of the deception here.
Yeah.
There is this mind-blowing statistic from the risk report. There is one specific USOH copycat contract. The address ends in A468C588.
I saw that one, yeah.
At one point, the trading data showed a spot price of $15 per token, and the circulating supply of that specific contract was exactly 1 billion tokens.
Can you just do the math?
Exactly. The portfolio trackers multiply that $15 spot price by the 1 billion tokens, and boom, it generates a calculated market capitalization of 15 billion US dollars.
And just to put that in perspective for you, that's larger than the market cap of many established legacy corporations with tens of thousands of employees and global supply chains.
It's a colossal number, but let me try an analogy here to see if I'm grasping how these algorithms are actually being tricked.
Sure, go for it.
It's like, imagine printing 1 billion shares of a completely fake startup in your basement. You convince your mom to buy exactly 1 share from you for $15.
Okay, nice of your mom.
Right. Very supportive mom. Then you immediately log on to social media and declare your basement operation a $15 billion unicorn.
Because of that one sale.
Yes. You point to the math and say, look, a share just sold for $15 and there are 1 billion shares. The paper says billion, but the actual demand, the actual cash in the room, is just that single $15 bill your mom gave you.
That is a perfect way to visualize it. You've just described the exact mechanics of a ghost market cap.
A ghost market cap.
Yeah. The ledger technically shows billions in value because the tracking algorithms, well, they just blindly multiply the last transaction price by the total supply. But it is completely disconnected from tradable reality. You couldn't actually sell the rest of those basement shares for $15 because there are no other buyers.
So what does this all mean for a new investor who sees that $15 billion number trending on their screen? Like, if the 15 billion isn't real, what actually happens mathematically when someone holding those tokens tries to cash out?
This is the core of the danger, and it's why so much retail capital just gets destroyed. It comes down to how AMM's automated market makers calculate price.
Right.
The risk report outlines the mathematical formula these decentralized exchanges use. It's a constant product formula, represented as X times Y equals K.
Okay, let's avoid the algebra lecture if we can. For someone new to this, how do we visualize X times Y equals K without pulling out a whiteboard?
Fair enough. Think of the AMM as an automated currency exchange booth at an airport, but one without any human operator.
Just a machine.
It's just a machine. The booth holds 2 things in its register: the USOH token and the cash backing it up, say Ethereum. The algorithm inside the booth doesn't look at the outside world at all. It only looks at its own register.
It's completely isolated.
Completely. It constantly adjusts the price of the token based strictly on the ratio of tokens to cash currently sitting inside that booth. If people buy tokens, they put cash in and take tokens out, so the token becomes scarcer inside the machine and its price goes up.
Got it. So if I walk up to this automated airport exchange booth, the digital screen on the outside might boast an incredibly high exchange rate, say $15 a token. But if I actually pry open the cash register inside the booth, there might only be $4 physically sitting in the drawer.
Exactly. And we aren't exaggerating with that $4 number for dramatic effect either.
We really aren't.
If we look at the real-time trading view data from July 11th, 2026, for a USOH and Ethereum trading pair on the Base network, the total pool liquidity, so the actual tangible cash in the register, was literally just $3 to $4 US.
Wait, I want to make sure I'm hearing you right. $3 to $4 total. For the entire market of a token that portfolio trackers say is worth billions.
Yes. The total available exit liquidity was less than the price of a cup of coffee.
That is just, if the math guarantees 0 and there's only $4 in the register, who is taking the other side of that trade? When someone tries to sell, what is the exact mechanism that destroys the capital?
Well, let's go back to the rule of the booth.
Yeah.
X times Y must always equal K. K is a constant. It cannot change.
Okay.
Let's say you hold a huge bag of USOH tokens and you try to sell them to the booth to extract just $2 out of that $4 pool.
Which seems like a tiny withdrawal.
It seems tiny, but relative to the pool, you are trying to remove 50% of the entire cash reserve.
Oh, wow. Yeah.
Because the booth must keep K perfectly balanced. When the Y variable drops that drastically, the math forces the algorithmic value of the token, the X variable, to plummet instantly to compensate. It's an unavoidable mathematical law.
It has to balance.
Exactly. The algorithm aggressively crashes the token price to practically zero just to balance the equation. This is a phenomenon known as massive slippage.
Slippage, which explains those horrific crash charts we saw in the risk report.
Right. Because of this extreme lack of liquidity, that $15 billion USOH contract didn't just experience a bear market dip, it instantaneously collapsed to $0.000000000000000000000
Basically zero.
Basically zero. And another USOH contract listed in our sources, one ending in 9C92, went from a paper valuation of $6.233 billion straight to zero.
So it's not a market correction at all. It's a total unrecoverable wipeout.
It is the mathematical destruction of 100% of the invested capital. The second someone tries to realize that fake paper wealth by selling, the constant product math breaks under the lack of liquidity, and the capital just evaporates into thin air.
But this raises a massive logical question for me. If cashing out destroys the token, who is providing those $4 in the first place? Like, how are developers convincing anyone to put real money into a pool that's mathematically destined to crash?
Well, to understand that requires us to look away from the math for a second and look directly at the marketing engine that fuels this entire illusion.
And here's where it gets really interesting. If we pull up the Binance Square social media stream from Degen Times, we see the exact playbook. I mean, in the traditional business world, building value takes time.
Right, usually, yes.
You develop a product, you establish brand trust, you secure institutional backing. But in this unregulated microcap space, value relies entirely on viral, hyper-coordinated social media blitzes. According to the Ledger data in our sources, 10% of the entire USOH token supply was transferred directly to a massive crypto influencer known as Ansem the very moment the token launched.
Right. They completely bypass traditional marketing and go straight for localized, concentrated social influence. They aren't trying to build long-term value. They are trying to manufacture immediate, frantic attention.
And the social posts we have show how incredibly varied these psychological strategies are. It's not just one pitch.
Oh, they try everything.
They really do. For instance, there's a token mentioned called the N-Bull. Their community pushes this narrative of organic grassroots momentum. They brag about bypassing influencer budgets entirely, offering a 0% tax and locked liquidity to lure people into feeling safe.
It's the illusion of a fair game.
Exactly. The illusion of safety. And then there's another token mentioned called Trumposhu. And looking at this purely from a behavioral psychology standpoint and strictly as an objective analysis of market mechanics, it's fascinating.
It really is.
Our sources show they are basically strip mining political sentiment just to bootstrap a liquidity pool. Their pitch claims to observe market manipulation and predict the second push of market cycles before the crowd gets loud. They are selling the idea that you, the buyer, are outsmarting the system.
If we connect this to the bigger picture, what you are seeing is an ecosystem desperately trying to manufacture conviction out of thin air.
Just creating hype.
Exactly. In the absence of real institutional capital like banks or hedge funds providing deep liquidity, the asset's valuation relies entirely on narrative momentum. Attention literally is the liquidity.
And what happens when that attention fades?
The market dynamics here are utterly brutal. The experienced players, the scalpers, they rush the first candle, meaning they buy in the very first milliseconds of the launch, artificially pumping the price and the hype.
Getting in on the ground floor.
Right. And they are the very first to leave the moment the market structure shows any weakness. Once the social media attention inevitably migrates to the next shiny token, the automated market makers are systematically drained by those early adopters. The liquidity vanishes, the math breaks, and the token functionally dies.
Leaving the retail investors holding bags of literally worthless code.
Just holding empty bags.
It's a high-speed game of musical chairs, but someone is taking the chairs away at the speed of light. To truly grasp the scale of this risk for a new investor, I think we have to compare this chaotic, decentralized environment to the traditional markets that these tokens originally claimed they were democratizing.
That is a vital comparison to make. Let's look at the traditional side first. Take the United States Oil Fund, LP, known by its ticker USO. This is a standard exchange-traded fund.
Right, the old school, regulated way to invest in oil without actually buying physical barrels for your garage.
Exactly. The USO is registered with the SEC. It is overseen by the CFTC. It holds actual physical treasury bills and regulated WTI crude oil futures contracts.
Real assets.
Real backed assets. But most importantly for our discussion today, it features deep institutional liquidity. We are talking about over 4.2 million in daily share volume. You can buy or sell millions of dollars worth of this asset in a single afternoon without the price suddenly crashing to zero because the capital depth is there to absorb the trades.
And then we have the decentralized synthetic version, the USOH tokens floating around on Solana and Base.
The complete opposite end of the spectrum. They are unregulated, permissionless, and completely unbacked. If you hold USOH, you have absolutely zero legal rights to redeem that token for a barrel of physical oil.
None at all.
None. They are subject to smart contract exploits, and as we just broke down, they feature single-digit dollar liquidity pools.
There's deep irony here, too, regarding how they market safety in that space. The Binance Square posts heavily mention a platform called Hood.Fun, which launched on the Robinhood chain.
Right, I saw that.
Yeah, it aggressively promotes itself as a secure, fair launch platform. Their big selling point is that tokens are put on a bonding curve, and once they hit a certain threshold, the liquidity is permanently locked into a Uniswap pool. They claim this protects traders from rug pulls.
The intention there is purely mechanical, really. It just proves to the buyer that the developer cannot unilaterally withdraw the liquidity and steal the funds.
Right. And it sounds incredibly safe to a new investor. Lock liquidity. Yeah. It sounds solid. But here's the massive blind spot. Even if the liquidity is locked by an immutable smart contract, if the underlying structure of that pool only manages to attract a few hundred or a few $1,000s, the decentralized micro-liquidity still leaves retail investors highly vulnerable to total loss.
Absolutely.
A permanently locked cash register with only $4 inside it doesn't help you at all if you're trying to cash out a $1,000 trade. You aren't protected from the math. The slippage will still mathematically destroy your capital the second you hit sell.
Precisely. Locking the liquidity proves the developer can't steal it, but it does absolutely nothing to solve the fundamental mathematical problem of extreme illiquidity. A locked empty box is still an empty box.
So, to summarize the core lesson for you today, and really for anyone navigating this space, paper wealth in speculative digital tokens is a complete and utter illusion if the underlying liquidity isn't there to support it.
The cash has to be there.
It has to be. A soaring spot price multiplied by a massive supply means absolutely nothing if the actual cash register is empty. Your portfolio tracker might tell you that you are a billionaire, but the underlying math says you can't even afford lunch.
And my final warning on this would be very clear. Unless a smart contract is fully audited, legally wrapped, backed by physical reserve custodians, and trading on platforms with deep, verified institutional liquidity, investing in these narrative-driven ecosystems is a near guarantee of a negative 100% return. You are fighting against constant product mathematics, and the math always wins.
It's a very stark reality check. Which leaves us with a final thought to ponder as we wrap up this deep dive. If a digital asset can be worth $15 billion on our screens, while having only 4 actual dollars in cash behind it, it forces us to ask a much larger, frankly, philosophical question.
Oh, for sure.
As our digital lives and our global financial systems become increasingly abstract, layered, and complex, how much of the broader economy are we casually assuming is built on solid ground, when it might actually just be lines of code backed by absolutely nothing?
That is an important question indeed. It's a very unsettling thought to leave on.
Something to think about next time you check your balance and see a number you don't quite understand. Thank you so much for joining us on this deep dive. We'll see you next time.